Hello everyone, welcome back. Now see here, this is only a quick recall. I would repeat once again, this is only a quick recall. The 15th question, this is the risk management frequently asked questions. Second part, that's part 2. Okay, so see here, this in this the question number 15. So what's the question? Just look at the screen. Obligator, that is the obligator rating. Obligator rating takes into account various dash. What dash? Is it financial ratios, credit history of the borrower, probability of default, or all of the above? As the answer, you can see it's been highlighted in red color, all of the above. So I will just explain you in short all of the above, how will it come. So see here, the term obligor, not obligator, sorry, I've just mistaken you in the initial. The term obligor, okay, the term obligor refers to the obligor means refers to an entity under obligation to an entity who is under an obligation to repay the loan or the investment. So obligor rating is nothing but it's a general assessment which is based on financial and other features or other traits, including previous defaults, to arrive at the current probability of default. Thus the answer is D, all of the above. The next question is next question, just have a look. Experience of key persons such as director, it's the management level, directors, partners, etc. will form a part of dash assessment. Which assessment will they form? As the answer, you can see it's been management risk. So they will form a part of which assessment? Management risk assessment. How management risk assessment? Not only to know the answer, but to know behind the answer what's the reason. So see here friends. So first option is financial risk, right? So what is financial risk? I would explain you the each risk. Financial risk, what the risk mean? It's normally evaluated on the basis of the analysis of balance sheet and other financial statements, right? The next comes the management risk, which is the answer for this. So what is it? Management risk means is assessed by studying the experience or expertise of the key managerial persons. Okay, that's why the answer is management risk here. Next risk is industry risk. What industry? Industry means it already defines the word industry. By studying the industry trends and prospects, economic and various environment which affect or influence the profit of the respective industry. Thus, industry risk is that. Okay. The last risk which they are mentioned here is business risk. Now, what is business risk? As the name suggests, business risk is regarding the strategic or the important decisions regarding the products or the market segmentations or business development strategy adopted and so on are the business risk. So I have explained you the 4 risk: financial risk, management risk, industry risk and business risk. Answer for here is the management risk. Move back to the next question. Next question is the back testing is done to dash. How is the back testing done? So they have given 4 options here. Just have a look. The first is a tester model. Compare the model results and the actual performance. Third comes the record performance. And the fourth is none of the above which is mentioned. Okay. So what's the answer? Before moving to the answer or before seeing the answer, don't directly jump to the answer as it's been directly highlighted. Just you think once again what will be the answer for the respective question. Okay, see back testing. What is back testing? Back testing, you should know the meaning. Then only you can able to answer the respective question, right? So first learn back testing. What is it? Back testing is it's a process of comparing. Okay, what will we compare? Comparing the results predicted by the respective model for a particular, or you can say for a respective term, with the actual results during the period. Okay. See, once again I would repeat the answer. Back test. So back testing, back means previous, as the name itself mentions you, back, that is previous testing. We will see or we will predict this we will predict the future. Okay, how will we predict the future? By predicting the respective model, that is the back testing model for a specific term with the actual results what they have now. Okay, what the with the actual results during the specific term is called the back testing. That is, the answer is we will compare the model results and the actual performance. Moving back to the next question in this slide, the last question in this slide, which risk is also called a default risk? So which risk? We need to name the risk which is also named as or also known as default risk. There are 4 options given here: operational risk, market risk, credit risk and interest rate risk. So the answer they have mentioned is C, credit risk. So credit risk, what is credit risk? The possibility of default. Okay, see, listen carefully friends. The possibility of default by a borrower, okay, to repay a loan is a major credit risk for a bank, right? So incidentally, default risk is also applicable in respect to investments, or in respect of investments you can say. If a bank purchases a bond and on the maturity, the issuer of the bond does not pay the maturity proceeds. So what will the bank lose? The entire money the bank will lose, right? So this risk also falls under credit risk and is not considered as a part of the market risk. It will be considered in the part of credit risk rather than market risk. I hope you are able to get the answers. Then in this slide, see, there are 2 questions given. In the first question, just read the question. Don't directly read the answer. Just read the question and the options given. Okay, I will explain you each and everything why this is not the answer and why this is the answer. So just have a look on the question. The four major cause due to which the 4 major cause. Okay, so what is the cause? The operational risk, they are having different segregations. There are different types they are having in operational risk. Okay, which is some major things are affecting those operational risk category. That is the operation risk factors. Okay, so what are they? As they are given 4 options. The first option is process. You can read here. The first option is process, people, systems and external. The second option comes the legal, reputation, concentration and external. The third comes the procedure, people, liquidity and legal. I am going a little bit fast. You just have a look. You just have a look on the screen, because we need to go for the entire risk management questions. That's the reason I am going a little bit fast, because it will be having more than 150 questions for you in your FAQs, which is very important to see each and every question. Okay. Then the last option was the people, systems, procedures and internal events. So the answer, as you can see here, is the first option, that is the A, process, people, systems and external. So why is it? See friends, operational risk. What is operational risk first? First, let me know what is the operation risk. Every time, whatever question they will ask, the answer will be in that question itself. The name will suggest its answer. Half answer they will suggest. Half we need to think and tell the answer. So see here, operational risk. What is operational risk? Okay, operational risk is nothing but a risk of loss which is resulting from inadequate, or you can say from failed people, failed process, systems or external events. Okay, it includes legal risk. It excludes strategic and reputational risk. Remember one thing, it includes legal risk. It includes legal risk, but it excludes strategic and reputational risk. It excludes strategic and reputational risk. So in the second option, legal is there, but it excludes reputation, right? So this option will not come. Third option is legal is there, liquidity will not come. Liquidity they are excluding. Then the fourth option, they are having internal events. Internal events will not come. Instead of that, external events will come into consideration. So the answer will be the A, process, people, systems and external. Next, moving back to the next question, that is the last question in this slide, which is which category of operational risk events encompasses losses from KYC and guidelines breaches. I would repeat once again the question, which category of operational risk events encompasses losses from KYC and guidelines breaches. There are 4 options given: business disruption and system failures. Second option is the internal fraud. Third comes the execution, delivery and process management. The fourth is the clients, products and business practice. Okay. Now, what's the answer would be there? The answer will be the last question, the last option, that is clients, products and business practice. So see here, why the answer will be last? Because breach itself means breach of confidentiality. Okay. Okay friends, breach of confidentiality. Okay. Breach of confidentiality of KYC information falls under clients, products, business practice of operational risk events. That's why the answer will be the last option, that is the clients, products and business practice. Then friends, in this question in the slide there are 4 questions. Just have a look here. We will move on one by one. The first question, that is the 21st question, is the strategic risk is a type of dash. So there are 4 options given. So what is the type of strategic risk? Okay, strategic risk is a type of dash, interest rate risk, operational risk, liquidity risk and none of these. Okay, so the answer is D, that is none of the above: interest rate risk, operational risk and liquidity risk. Okay, so just see here. So why it's none of the above, I will explain you now. Strategic risk is a type of dash, right? So operational risk, what is operational risk? Here they have given one option, operational risk. Operational risk itself, it includes legal risk, but it excludes strategic and reputational risk. But it excludes strategic and reputational risk. Okay, thus B is not the answer. B is not the answer. B can be the answer, but here as it includes legal, that is correct, but it excludes strategic and reputational. That's why interest rate and liquidity will not come into strategic risk type. Okay, B will come, but as it excludes strategic and reputational risk, it will not come for the answer. Therefore, B is also not the answer. The answer will be D, none of the above. Moving back to the next question. The risk of prepayments. The risk of prepayments of loans and bonds and or premature withdrawal of deposits is called dash. I would repeat once again, then I will explain you. See, the risk of prepayments. Okay, the risk of prepayments of loans and bonds and or premature withdrawal of deposits is called dash. So then there are four options given. The first is the liquidity risk, prepayment risk, embedded option risk and the credit risk. Okay, so what is the answer? The answer will be embedded option risk. Why? Embedded option. So what is that? This is such as the option for a customer, you can say a customer to prematurely encash the deposit, or prepayment of loans creates uncertainty regarding the cash flow from the assets. Okay, the cash flow will, but it will vary. Okay, the cash flow will vary depending upon whether an option is exercised or not. I would repeat once again, this is also an important question. Just mark it as important. Every questions are very important exam point of view. See here, the answer is C, embedded option risk. So what is that? Embedded options such as the option for a customer to prematurely encash the deposit, or he will prepay the loans which will create uncertainty regarding the cash flow from the assets. Okay, the cash flow will vary depending on whether the option is exercised or not. The next question is the process risk. So what is process risk? Process risk means there are 4 options given. Now we will see what is process risk. Process risk means dash. First is transaction risk, operational control risk and model risk. So all of the above. So what will be the answer? Process risk means dash. So what is the answer here? Process risk means all of the above. All of the above. So they will be having transaction risk, operational risk and model risk. Okay, so that is called process risk. Then comes the next question. Next question is you can see the last question in this slide. In the slide there is the last question under the BIA. BIA means basic indicator approach. Basic indicator approach. Under the basic indicator approach, banks in India have to hold capital for operational risk equal to this. You may be knowing, friends, because you are already a banker, so you may be knowing. So see, under the BIA, that is under the basic indicator approach, banks in Indian banks have to hold capital for operational risk, which is equal to dash. There are 4 options given, which is equal to, you may be aware of. So dash, that is the 3-year average you need to see. 15% of the gross profit, 15% of the net profit, 15% of the gross income, or 15% of total risk weighted assets. So the answer here is the C option, that's 15% of gross income. 15% of gross income. So C option. So see here, the percentage, that is the 15%, has been prescribed by RBI. Reserve Bank of India has prescribed the so and so term. Okay, it should be that. So answer is gross income. So what is gross income, friends? See, the gross income is defined as, listen carefully, the gross income is defined as net interest income, that is NII, net interest income plus the net non-interest income. Okay, net interest income plus net non-interest income. Okay, as it's mentioned 3-year average, so that the 3-year average of gross income is to be calculated. If a gross income is 0 or negative in any year, you can say, then that has to be excluded, and that calculation has to be the average of the other years only. I would repeat once again, this is important question, but you may be aware of. So just see here, the 15% is prescribed by RBI. Okay, so see, what is gross income? Gross income is nothing but, as the answer is 15% of the gross income. So what is gross income? This is defined as net interest income plus net non-interest income. Okay, the 3-year average, as they have mentioned here, if suppose in the 3-year average, one of the year the gross income is 0, or you can say negative in any year, then that has to be excluded from it, and the calculation has to be done on the average of the other years only. Okay. Then friends, moving back to the next question. So see here, the first question, you can look at the screen and concentrate. The first question, 25th question, objective of liquidity management. So what is the objective of liquidity management? Objective of liquidity management is to dash. Okay, there are given 4 options: ensure profitability, ensure liquidity, either of the 2, that is the either of the A or B. The 4th option is the both, that is ensure profitability as well as ensure liquidity. So what's the objective of liquidity management is? Answer is D, both. That is, it is essential that the banks maintain sufficient liquidity to meet its financial commitments. They may be having, or they are having financial commitments, right? So it is very important for the banks to maintain its sufficient liquidity, okay, to meet its uncertainties. So liquidity comes with a cost for a bank. Holding surplus liquid funds far beyond the requirement would affect the profitability of the bank, right? You may know. See, holding surplus liquid funds. Surplus means it's normal liquid funds, then fine. If the bank is not required so much liquid funds, it's a surplus liquid fund. The extra amount is there, which is far beyond the requirement, would affect the profitability of the bank. So hence liquidity management should also focus on reducing its surplus liquidity to how much is possible for them. They should be able to focus on reducing the surplus liquidity to an extent, you can say, and ensure the maximization of profits Moving back to the next question, the next is banks need liquidity. Why banks need liquidity? As a banker, you may know why banks need liquidity. There are 4 options: meet deposits withdrawal, fund loan demands, both of them, none of them. So the answer is C. Banks should maintain sufficient liquidity to pay depositors. Why? Because see, who may be withdrawing funds, so the banker or the staff should be having that time the amount, okay, so that the bank can pay to the respective depositor either on maturity or before maturity. Bank should also maintain sufficient funds to allow borrowers who have been sanctioned limits by the bank to withdraw money from their accounts to an extent which is which is permitted by the sanctions. So incidentally, banks should also maintain sufficient funds to repay any borrowing or other obligations that it may have to others. So thus the answer is C, both of them. So banks need liquidity to meet their deposits withdrawal as well as fund loan demands. The next question, moving back to the next question is, what does interest rate sensitivity ratio indicate? See, what does interest rate sensitivity ratio indicate? There are four options. The first is ratio of interest rate sensitivity assets to rate sensitive liabilities. Second is capacity and willingness to absorb losses. Third is securities that can be readily sold for cash, and the last option is none of the above three. So the answer is A. Why? Because see, the question they have asked is interest rate sensitivity ratio. Interest rate sensitivity ratio indicate ratio of interest rate sensitivity assets to rate sensitive liabilities. Assets is equal to liabilities, right? So ratio of interest rate sensitive assets to rate sensitive liabilities. The last question, see, when does call risk happen? So call risk, what is the term call risk? Okay, when does this happen? There are four options. Just have a look there. It happens on account of crystallization of contingent liabilities on account of embedded options. Or the second option, when there is a need to let's say to give someone or to compensate for non-receipt of expected inflow of funds. I hope you understood the word non-receipt of expected inflow of funds. And the third option is when a bank fails to manage its intraday liquidity. And the last one is where changes in market interest rates might adversely affect NIM. Okay, now see here first. See, so when does call risk happens? Call risk, when it happens, the answer is A. Why? Because I will give you an example here. Let's say I will give you an example of call risk. Is that, see, a depositor may close his deposit prematurely, or a borrower may prepay his loan installments, thus upsetting the liquidity calculations made by the bank, right, on the originally maturity schedules. So see here, if a depositor is there, if something investment is going to mature on after 3 months. So bank is not having the funds right now, and the depositor suddenly walks in to the bank and he prematurely closes his deposit, and he say, I need the money, I need to close the investment. So that time the bank will be upset with the liquidity calculations which they have done on the originally maturity schedules. That means they will be assuming this is the maturity schedule, means that time only they will be needing the sufficient funds, not this time. So if suppose uncertainty occurs, that is the uncertainty is the risk. That's the call risk, is that a depositor may close his deposit prematurely, or on an other side you can say a borrower can prepay his loan installments. Both will affect the liquidity calculation made by the bank on the originally, on the originally maturity schedules. So in this video we have covered 14 questions of risk management frequently asked questions. Okay, in a next video we will be uploading more and more questions, which will be total in all it will be covering 150 plus questions for risk management exam point.